You know, I'm seeing all these posts online that says buyers think it's 2008, sellers think it's 2021. I think I'm 35. Well, you know what? All of those things are hopes. And guess what? Hope is not a course of action. What you see today, is it the new norm? We're going to get into that and so much more on this episode of the Housing Market Update. Let's start with the big three. Prices. Prices surprisingly are up. We saw that in the report that came out for the month of June. We'll see here in about 2 weeks what the July prices look like with the HBR, the Honolulu Board of Realtors report. But right now, prices are up. Inventory is also up, and rates. Rates, they're fugly right now. We'll get into that. Here's the headlines for the week. Oil prices are back above $100 a barrel. That has shot interest rates to really high, the highest we've seen in over a year, about 14 months. And I want to talk to you about the 21st Century Road to Housing Act that was passed through both houses of Congress. The president vetoed it, or he didn't sign it, so it went into law. And you know what? Is it a big deal or is it not? We're going to get into that. And I think you might probably not be surprised at what I'm going to say. And then HOA, Homeowners Association. Is higher prices and HOAs, is that the new norm? Will they go down again? I got some surprises. Actually, ain't no surprises for you here. What's going to happen there? And then we'll take a quick look at VA rates as we end the week. All right, so let's take a look at interest rates. Interest rates today on Thursday, July 23rd, they just popped to the highest that they've been in about, we're talking like 14 months. So highest in over a year at 6.85, almost 7% for conventional rates. This is, again, the highest that we've seen since August, maybe actually I think now May of 2025. And why is that? Well, you know, we've been at war with Iran for really 4 months now, and you know, oil prices, they initially shot up above 100, and then they actually dropped into below $70 a barrel. But then tensions increased, and you know, Iran, I think we've been bombing Iran for about 10, 11 days now in a row, and Iran has been firing back, and now one of Iran's proxies, the Houthis, which are out of Yemen, they have entered the war now as well. Not only have they threatened shipping going through the Bab al-Mandab Strait, which is going into the Red Sea, not only have they made that threat, they have actually fired on 2 Saudi Arabian oil tankers. So now there are 2 vital checkpoints or sea lanes of communication that are being attacked, and the shipping in those going through those lanes is being attacked, which is really causing not only interest rates but oil prices to spike above $100 a barrel. And really, there is no reason for oil prices to come down until we get to some sort of peace arrangement, at least allow the shipping to flow. And here's the big question. You know, it's funny. When I was in the military, I was told often, and I learned this very early in my career, that the first report is always wrong. And the second report is also wrong. It isn't until we get the third report that we get some semblance of the truth. And that's kind of what we're seeing with the U.S. and President Trump saying, yep, we've got them taken care of. We've secured it. We're going to keep on them. We're going to get peace. And, you know, oil prices are going to come down. The stock market's going to go up. You know what? We keep hearing that. And you know what? It's kind of like, you know, screaming fire in a crowded building. You do that so many times, people are going to start ignoring you. And guess what? Iran's ignoring everything that he's saying, because guess what? They're firing. And I thought we had taken care of all their military. Maybe we have, but we haven't taken care of the IRGC. And they're still shooting missiles and drones and attacking not only shipping, but they're attacking their Middle East neighbors. This is kind of going off on a tangent here, but until we slow down and stop the attacks in the Strait of Hormuz and Bab al-Mandab Strait, until we see a cessation of those hostilities, we can expect to see higher interest rates. And here's the other thing that is really moving rates or keeping interest rates high, and that's inflation. Well, the last inflation report that we received last week, the CPI actually was down. That was because oil prices had dropped into below $80 a barrel. Well, now we're back up $100 a barrel. So again, the fears of inflation not going down. And you know, before the end of February, before we went into Iran, inflation was coming down. Things were looking good. We were talking about the Fed cutting the Fed funds rate. Well, guess what? That's off the table now. And guess what happens next week? The Fed meets. So over the next couple of weeks, there's a couple of big reports or big things happening that we need to watch in the economy, the Iran war aside. The first is Tuesday, Wednesday next week, the Fed meets. This is their second meeting with the new Fed chair, Fed Warsh. It is widely expected that the Fed will not touch short-term rates, the Fed funds rate. They're expected to stay between 3.5 and 3.75. The big news is going to be, though, what hawkish tone will the Fed take coming out of that meeting? We've already seen a bunch of the Fed heads talk about having to raise the Fed funds rate. There are multiple Fed governors or presidents who have said that, which is kind of contrary to what Fed Chair Warsh said when he said he did not want the markets reacting to what the Fed personnel are saying. He wants the markets to react to the economy. But guess what? That hasn't stopped them from talking. So this meeting will be interesting, the tone that Fed Chair Warsh comes out on Wednesday when he speaks to the press, what he says, what his feelings are about maybe another Fed rate hike in September or before the, certainly before the year ends. Certainly no talk on the table right now of lowering the Fed funds rate. And for me, I am interested in what is Fed Chair Warsh going to say with regards to the housing market. Fed Chair Warsh has correctly surmised that the housing market is an expanded slump. We are in we're not in a recession really anywhere else. Housing market, though, is a big recession with interest rates being really, between 6 and 8%, actually 7 and 8% for a few times over the last couple of years. So that's happening Tuesday, Wednesday. Thursday is the PCE, and this is the Fed's favored measure of inflation, the Personal Consumption Expenditure Report. And this is 2 months old now. This is 2 months old data. This is May. May, inflation actually was coming down. So we might actually see a tamer inflation report come out on next Thursday. But if that inflation report comes out hot, the interest rates could go up again. So really, we got two big things happening next week, the Fed and the inflation report. And there really is no expectations really over this next week for rates to come down. There just isn't. So the bottom line here is expect continued volatility, expect interest rates on conventional to stay near 7%. They could pop above 7% if inflation goes up and if the Fed is unusually hawkish coming out of their meeting. So again, expect continued volatility, 6.5 to closer to 7% or beyond for conventional. VA, right now VA, well, we'll get into VA in a minute here, but VA is certainly up higher than it has been over the last year as well. Here's the other thing, I've had several clients go into contract and a lot of people like to gamble and they're like, I'm gonna wait for rates to come down. To me, that is a reckless gamble to wait for rates to come down. And one of the reasons why you work with a broker is you lock yourself in right away and then you're safe. Because guess what? If my clients who locked 2 days ago, well, rates are a quarter point higher now, but they don't care. They're locked in at a lower rate than they would lock in today. So my thought is you lock in, or if you're a buyer, you lock your rate in. And if rates fall off a cliff over the course of the next couple weeks, then maybe you shift to another lender. That's what your broker can do for you. All right, because as a broker, I'm shopping with 30 different companies to get you that best rate. So really, stay safe, lock it in. This is from the guy who goes to Vegas and doesn't gamble. I don't gamble with my money. I don't gamble with yours either. At least that's how I look at it when I'm talking to my clients. But really, lock it in, be safe, move on. All right, a couple of weeks ago, both houses of Congress passed the 21st Century Road to Housing Act. And, folks, let me tell you, this is the same movie that we have seen before. Every few years, Washington passes a landmark housing bill that it tells American families that relief is on the way. 1949 Housing Act promised the same thing. It promised a decent home for every family. It didn't happen. And this is being called the biggest bipartisan housing package in 30 years. Well, guess what? That's the same language that was used on the last one and the one before that. Now, here are some things that this landmark act will do. All right, these are 4 can-do items, but these are mechanisms. Not one of these items actually builds more homes, and it doesn't make housing affordable. All right, what it does is it removes barriers and it creates incentives mostly for builders and for state and local governments. All right, it does not build a single home by itself, and it does not lower a single payment by itself. Super important to remember. All right, not more homes, not cheaper homes, not lower mortgage payments. This act does none of those things. All right, nada. So let's go over these 4 items. First, cutting the red tape. All right, basically streamlining government environmental reviews of federal permitting so approved projects can move faster. All right, again, this is at the federal level though. This is not at the state and the local level. This grows factory-built housing. So basically, it's cutting costs and expanding manufactured and modular homes as scalable supply. Third thing is it pushes local reform. So it ties federal funding incentives to local governments that streamline zoning and housing production. All right, and then fourth, it modernizes financing, expands small dollar mortgage options, and supports office to residential conversions and ADUs. Here's the kicker here. This is basically a federal document that is making it easy at the federal level. However, the states and the local governments, they need to take action to make their permitting and zoning processes easier, to allow ADUs to be built easier, to allow the conversion of office to residential space easier. And guess what? We haven't seen many state and local governments do that. So again, these are cans, these are mechanisms, but they don't help unless the state and local government does. Let's talk about where this new law falls short. First, there's no immediate relief. Many of these provisions won't actually affect supply until 2027 or later. All right, here's the biggest one in my opinion. Rates and prices are untouched. All right, we have elevated mortgage rates. Fed Chair Warsh, when he was talking to on Capitol Hill last week, talked about this. He wants interest rates to come down, mortgage interest rates to come down. President Trump wants mortgage rates to come down. This bill does none of that. All right, and if for rate locked owners, people who have a low rate and they want to move, there's less incentive for them to move. They're not getting any benefit from this. And here's the other thing. This also misses the lowest income households. All right, the financing favors those in the 60 to the 80% median income projects, the gap financing, but what about those 30% AMI? AMI is the area median income. What about those poorest who want to buy a home, but their income is 30% of the area median income? Well, we don't fix that income problem. We don't fix the affordability problem with this bill. All right, it misses the lowest income households. Wage growth it's not addressed. All right, affordability is also, it's not just that price of the home problem, it's also an income problem. We have an improved income for potential home buyers. We have stagnant wages right now. The wage growth needs to be higher than home price growth, and we're not seeing that. Or at least on par with home price growth, and we haven't seen that in years. We're really stagnant income for most Americans. And I talked about this on the last slide. All right, the benefits of this act are placed largely on local governments. Local governments to remove restrictions, not just talk the talk, but also to walk the walk. And we haven't seen that yet. Again, they haven't had time to react to this bill, but let's face it, folks, most of our local governments are failing in that area. I know in Hawaii we're failing. I know certainly across the country there are many areas that are failing. There's just not enough supply, and none of these things that the act puts into play impact building more homes in your locality. They just don't. They just remove barriers from building them. And here's a quote, all right? A law like this is a foundation. It is not the finish line. You know what? This law does very little to help our economy right now. It does very little to help home buyers, to help home sellers at this moment. I see nothing in this bill that truly positively impacts the market right now. All right, what it is, it's a promise of future supply, but it is not delivering on present relief, which is what we need right now, especially with foreclosures, with FHA, which is a first-time homebuyer loan, and veterans with their VA loan. Foreclosures are up 21% year over year right now for foreclosures for first-time homebuyers and for veterans. There's no present relief for that. We need interest rates to come down. We need more supply. We need more supply fast. But I tell you what, the biggest thing, get those interest rates down and you'll start seeing some movement in the market, all right? And it won't smell so bad. It's like stagnant water. It starts to smell. We need movement. We won't see movement until we see rates come down. All right, here's some more doom and gloom for you. Why $1,000 a month HOA dues, homeowners association dues, are becoming the standard on Oʻahu. Now, I've been a lender for 10 years. And when I first started in the industry, whenever I was estimating what HOA dues would be, I always estimated $500 a month. That was 10 years ago. About 3 years ago, I increased that to $750 a month. Now I am estimating $1,000 a month. If your HOA dues are less than $1,000 a month, woohoo, raise the roof. That's good for you. But the average is getting closer to $1,000 a month now. And it's super important that when you're pre-approved, you know what the estimated HOA is going to be, because a lot of these mainland lenders who pre-approve you, they don't know anything about HOA dues out here. And so they may say you're pre-approved for $600,000. But they're not taking into account that $1,000 HOA or that $700 HOA. So you might actually not be approved for that $700,000 townhome that you thought you were approved for when you went to that mainland lender. I tell you, when I do your pre-approval, you're gonna know exactly what your pre-approval amount is good for and what that HOA estimate is gonna be. And from there, you have a really good idea of what your buying power is. Now, a lot of people are wondering, well, gosh, are HOA dues gonna come down? As I have said before, hope is not a course of action. There is no reason to believe that HOA dues are going to go down. It is not realistic to expect them to. They never have. Now, some have gone down recently, but they went from, say, $600 a month to $1,200 a month, and now they're $1,000 a month. And a lot of this initial spike was due to insurance costs going up due to the Maui wildfires, and then the consequential increased hurricane and catastrophic risk pricing, which hit all of Hawaii. We just had certainly that Kona low storm on the North Shore. That is not helping for future homeowners insurance rates, certainly in those areas that are at a higher risk of flooding. And we just had the FEMA zones change too. So for some people, insurance premiums are going to go up even more. And with almost probably 90% of all associations, condo associations, the hurricane insurance, which is the expensive part of your insurance, that is part of your HOA dues. Now, here's the other thing. Some associations have struggled to find coverage at all and are pushing the individual coverage onto homeowners. So not only do you have to pay for your homeowner's insurance, you have to have your own personal added hurricane insurance. So that is another thing that is really negatively impacting the HOA prices. On top of that, post-Surfside, this was a Florida condo collapse that happened, 5 years ago. Reserve funding requirements, and reserve funding is basically every association must have reserve funds to cover roof repairs, to cover light repairs, They, if you have a pool, they have to have reserves to cover, maintaining that pool, replacing the liner in that pool. Well, there are now more strict reserve funding requirements, which means associations can no longer defer their maintenance or underfund their reserves. So they are legally and practically required to collect more each month to cover for those reserve shortfalls. And again, it makes sense, but you know what? There's a cost, and that cost goes to you, the condo or townhome owner. And then you add on top of that all the increases in the cost of labor, especially in Hawaii, and supplies, especially in Hawaii, because we don't build a lot of the things that we use with the associations, the building materials. We have to bring all of those in. So, kind of the moral of the story on this is, don't expect the prices to drop in HOAs. All right, this is the new normal. Higher is the new normal. And what is that impact to buyers and sellers? So right now, condos are in a holding pattern. We are at the highest inventory level of condos that we've had in over 10 years. But condo prices haven't fallen off a cliff. They're pretty steady. There's no reason sellers really should not expect their condos to sell for much more than what they bought. They may make money if they've owned the condo for a while because of the amortization of the loan, but they don't expect to make as much money on selling your condo as you would if you had a single family home, which doesn't have those HOA dues, or certainly has HOA dues that are 100% less. So for sellers, you must price transparently around your HOA fees, and you got to be totally transparent if there's assessments, because if you have a buyer and they get into contract with you, seller, and then they find out, oh wait, there's a special assessment of $300 a month or $10,000. Well, guess what you have just lost with that buyer? Trust. And when you lose trust with your buyer, there's a good chance your buyer will probably back out of the contract. And now you're back to starting over, and guess what? You have this mark. Because guess what? Everybody's gonna know that this house was your condo was in contract and then went out of contract. And guess what? You gotta be open kimono. You gotta let your buyers know everything up front. Don't hide it. They're gonna find it, and it's dishonest anyway. So here's the other thing. Not all HOA dues are bad. I know in my HOA, in my community, or at least in one of my communities, it covers everything except my electricity, sewage, water, cable, internet, phone, pool, jacuzzi, little park area, nice walk-in areas. You know what? My HOA dues, while it might be $800 a month, it covers a lot. Some they cover a lot more. Some don't cover much. So be very, very transparent. Highlight what the HOA fee covers. Super important. And then expect longer qualifying timelines. Higher dues reduce the buyer's purchasing power. Seller credits help that buyer's purchasing power. So if you can afford to give up $10,000, $15,000, maybe even $20,000 in seller credits, you are going to help make that home and that higher HOA more affordable for the buyer. And if it's not that important to you, then don't. But you're probably not going to sell your condo. And that's all I got to say about that, sellers. Now for buyers, budget HOA as part of your mortgage payment. All right, you PITI, principal, interest, tax, and insurance. Well, it's PITIA, PITIA. All right, PITIA. And that A, that's association dues. You gotta account for that in your budget. Talking with your loan officer, they will help you figure out what that budget with an HOA is going to be. It's not going to be the same as if it's a single family home. It's just not. Review. You get all sorts of documents when you're a buyer, and you don't read them all. I tell you, you read them. If you're having a hard time sleeping at night, you can read them then. That's a cure for insomnia. Your condo documents, your house rules, your reserve minutes, your board meeting minutes that you get, you have to review those. It is not your realtor's responsibility to review those. It is your responsibility. Now, a good realtor is going to help you out, All right, a good realtor, again, they want you to be a successful homeowner. They're going to review those things. But it is up to you to review your reserve studies, your minutes, your condo docs. All right, because once you own the house, you can't go back and say, well, I didn't know. You probably did, you just didn't read it. And then you gotta weigh a condo and a townhome versus a single family home. And if you can't afford to get a single family home, by all means, I would get a single family home, because single family homes appreciate better and more of your payment is going towards what you use, all right? Or actually what I should say is more of your payment goes towards your home. More into paying down the mortgage, more into paying interest, less into paying an association for stuff that you don't even use. I can go back to mine. I never use my pool. I never use my hot tub. I just don't. I don't want to hang out in a hot tub where there's a bunch of other people hanging out. So guess what? I don't use half of that, but you know what? The juice is definitely worth the squeeze in my neighborhood because I love my neighborhood. All right, but you gotta weigh that. You gotta weigh, what does it get? What do you need in that townhome with regards to association fee? There are some great townhomes in Eva Beach, down in Kamakana area in Hawaii. Man, they have some great amenities. I would pay for that. A gym. I won't play pickleball, of course, but they got pickleball courts. They got really nice pool, entertainment area. So again, you gotta really look and weigh condo, townhome versus single family home. And I would say for most people, if you can afford this single family home, go single family home route. But if you can't, then you just gotta really look at, you know, what does my HOA pay for you? And you have to budget properly. And here's the other thing. Don't expect condo prices to go up. Don't expect condo median sales prices to go up until we see interest rates come down. We have seen before that when conventional rates get below 6%, the market starts to move and prices start to go up. But we are going in the opposite direction. It took us a year to get down into near 6%. It might take us another year to get back. So don't assume that rates are going to come down right away. But once they do, expect home prices, even condo and townhome prices, to go back up. And then, you know, the last thing for buyers, with this high level of inventory we have right now, you are in a great position to get seller credits to buy your home and get your rate into something that's affordable. I just locked a young service member in at 5.125% on a 5/1 adjustable rate mortgage just yesterday. All right, she's not paying for that. The seller is giving her the credits. The credits are paying that. No money out of pocket. She's got an affordable mortgage payment, all right, because she didn't sit on the sidelines. And guess what? Once rates go down and her condo price goes up, she don't got to worry. She's probably just going to refinance in a 30-year at 5% or 5.125%. So really, this is a buyer's opportunity to take advantage of higher inventory and get a great deal on a condo, no money out of pocket, no money to pay your closing costs, and you get an affordable interest rate. 6.25, don't care if you're at 5.25, all right, because you got seller credits. Just saying, I'm seeing it happen every single day. All right, let's end with a quick look at VA rates. Again, you can see we're right at 6.4%. We've seen a steady rise really since the end of February, where, you know, if you look, we're moving in a really good direction into February. But hey, you know what? Things are out of our control. What you can't control, your budget, you control your attitude, absolutely every day. And you control whether or not you are going to pay a landlord or pay yourself. All right, either way, it's your choice. You control that. You don't control what's going on in Iran. You don't control what's going on in inflation. You control your attitude. And to me, that's the biggest thing. You control your attitude. Yep, rates are higher. They'll come down. They always come down. All right, it's just, we don't know when. And you know what? I don't know when. And anyone who says they do is full of shit. So control what you control. And if you're a buyer, you're in a good position right now, especially as that rates get higher because you have less competition. I like that. So that's all I got for you guys this week. Have a great weekend. Stay positive. Get outside. Enjoy some sunshine. Enjoy beautiful Hawaii day. And be positive. Aloha.
Okay, before we move on, I gotta say this. 91% of people watching this video now aren't subscribed to the channel. And look, If you're a Hawaii buyer, a veteran using your VA loan, or you're just trying to time the market right, this is exactly the kind of update you don't want to miss. So hit subscribe now, turn on notifications if you can, and let's get to the next report.